By the end of this video, you'll know exactly how to invest in Bitcoin without ever touching cryptocurrency directly. In January 2024, something happened that changed everything for everyday investors. The SEC approved the first spot Bitcoin exchange-traded funds. That approval opened the door for people to buy Bitcoin exposure through their regular brokerage account, just like they'd buy a fund tracking the S&P 500. And the last thing I'll tell you about fees and tax advantages. Most people find that genuinely surprising when they learn how these actually work. So sit back, grab a coffee, and let's get into how Bitcoin ETFs actually function. Here's the core idea. An ETF, an exchange-traded fund, is just a basket of assets that trades on the stock exchange like a regular stock. When you buy a spot Bitcoin ETF, you're buying a fund that actually holds Bitcoin. The fund manager buys the real cryptocurrency and stores it in custody. The magic is that you never have to set up a crypto wallet, deal with a cryptocurrency exchange, or worry about losing your private keys. Before the January 2024 approval, investors only had access to futures-based Bitcoin ETFs, instruments that track Bitcoin's price through derivatives rather than owning the asset directly. Those worked, but they added complexity that didn't sit right with regulators or investors. Then the SEC greenlit 11 spot Bitcoin ETFs all at once on January 10th. BlackRock's iShares Bitcoin Trust launched with ticker IBIT and quickly became the dominant player in the category. Fidelity came to market with its own fund, ticker FBTC, backed by the same institutional infrastructure Fidelity uses for its trillion-dollar asset management business. ARK Invest, managed by Cathie Wood, launched ARKB. Invesco, WisdomTree, Franklin Templeton, and Valkyrie all had their own versions in the mix. All of a sudden, Bitcoin was available through the same account you use to buy Apple or Tesla. Now here's where it gets interesting. Let me explain how the actual mechanics work, because this is what makes ETFs fundamentally different from buying crypto on an exchange. When a fund issuer like BlackRock creates new shares of its Bitcoin ETF, it goes out and buys actual Bitcoin on the open market. That Bitcoin goes into custody, usually with Coinbase custody or Fidelity digital assets. When you buy shares on the stock exchange, you're buying from another investor who is selling. The fund only needs to buy more Bitcoin when new money floods in and the share price drifts above the value of the underlying holdings. This process is called creation and redemption, and it's how ETFs keep their price aligned with the assets inside them. Because of this structure, you get some real advantages over holding Bitcoin directly on a crypto exchange. You don't have counterparty risk. When FTX collapsed in 2022, anyone holding crypto on that platform lost everything. If you held a Bitcoin ETF through a brokerage, your investment was completely protected. You also get access to Bitcoin through your IRA or 401k. That is a massive deal. When you buy Bitcoin on Coinbase or any crypto exchange, it sits in a taxable brokerage account. Every time you sell, you trigger a capital gains event. When you hold a Bitcoin ETF inside an IRA, you get tax-deferred growth. Inside a Roth IRA, you get tax-free growth. That's the same treatment you get with your stock funds and bond funds. If you've been holding Bitcoin for years on an exchange, moving that position into a Bitcoin ETF inside a Roth IRA might be the single most valuable financial move you can make. If you're finding this helpful, hit subscribe. I put out videos like this every week, and there's more coming on how to actually put this into action. Now, the part that surprises most people: the fee structure and the tax implications. BlackRock charges 0.25% annually on its Bitcoin ETF. That means on a $10,000 investment, you pay $25 a year. Fidelity's fee is 0.25% as well. For the first 6 months, BlackRock waived its fee entirely. They were trying to attract assets and build scale. Compare that to a typical actively managed stock fund, which runs about 0.75% to 1.5% annually. Over 20 years, that difference compounds into serious money. But here's the thing that really matters. The redemption mechanism actually creates a tax advantage. When authorized participants redeem shares directly with the fund, they hand over shares and receive Bitcoin in return. That transaction happens outside the public market. This means fewer taxable events for investors who just hold the ETF over time, compared to holding Bitcoin on an exchange where every trade can trigger a capital gains event. With an ETF and a traditional IRA, your gains grow tax-deferred. With a Roth IRA, they're tax-free. You get exposure to Bitcoin through a vehicle that works exactly like the rest of your portfolio. Buying one is straightforward. Open a brokerage account if you don't have one. Search for the ticker symbol IBIT for BlackRock, FBTC for Fidelity, or ARKB for ARK Invest, and place a standard market order. These ETFs work in IRAs, 401ks if your plan allows, and regular taxable accounts. Not every workplace retirement plan offers them yet, but most major brokerages do. There are risks. Bitcoin is volatile. We're talking swings of 30 or 40% in a bad month. The ETF doesn't eliminate that volatility. Regulations could shift. The SEC approval was a major step, but the crypto regulatory landscape is still evolving. But for the first time, you can access Bitcoin without dealing with cryptocurrency exchanges, without managing private keys, without worrying about whether your exchange will still exist next year. So here's what you got today. Bitcoin ETFs let you invest in Bitcoin through your regular brokerage. Spot ETFs actually hold the underlying asset, not just derivatives. The fee is reasonable, especially compared to actively managed funds. You can hold them in IRAs and 401ks for tax-advantaged growth. And the mechanics of how these funds operate mean fewer taxable events than holding crypto on an exchange. The January 2024 SEC approval changed the game for investors who wanted Bitcoin exposure without the complexity of the crypto world. Whether that's right for you depends on your goals, your risk tolerance, and how it fits into your overall portfolio. If this video helped, share it with someone who needs to hear it and subscribe. I'll see you in the next one.